Tata AIA Smart SIP plan. Will investing in this plan benefit you with financial security for your family and help you in the wealth creation process in the long run? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goal in a more faster and smarter way. But before analyzing this policy, let us first understand what is Tata AIA Smart SIP plan is about. So this is a non-participating unit-linked individual life insurance savings plan. And some of the key features of this policy is that you have 4 plan options to choose from, which are wealth secure, future secure, goal secure and family secure plan. And you also have the option to select waiver of premium or even income benefit to suit your financial needs. You can boost your fund with zero premium allocation charges, and there are additional unit allocations for especially female customers, and multiple investment fund options and investment strategies are for you to choose from, and there are wellness benefits from vitality riders. So tax benefits are also applicable as per the tax laws. Now let us take a look at the benefits available under this policy. So one is maturity benefit, which you get once the policy matures. So you can get the fund value including your top up premium fund value if any was valued at the applicable NAV on the date of the maturity of your policy. And this maturity benefit kind of differs among the plan options you choose. Suppose if you have chosen the wealth secure and goal secure plan, then if the policyholder is alive on the maturity date, this fund value premium top up premium fund value shall be payable to him. But if you have chosen the future secure and family secure value, then it shall be payable to the nominee in case where the life policyholder has died before maturity, or to the policyholder in case the life insured is alive as of the maturity date. So it kind of depends based on the plan options you have chosen for yourself. Death benefit also is it also differs based on the plan options you have chosen, which if you want to see in detail, you can definitely refer to the policy brochure. But the gist here is that in case the policyholder dies during the policy term and while still the policy is in force, then the nominee or the legal heir can get the death benefit, whichever they have determined as the death benefit according to the plan options, which you can refer to the policy brochure for more details. Now let's move on to understanding the investment strategies and the fund options available in this policy. So first let's take a look at the fund options. As you can see, there is a 15 investment fund options for you to choose from, which are Emerging Opportunities Fund, Sustainable Equity Fund, Multi-Cap Fund, India Consumption Fund, Top 50 Fund, Top 200 Fund, Super Select Equity Fund, Large Cap Equity Fund, Whole Life, Mid Cap Equity Fund, Dynamic Advantage Plan, Flexi Growth Fund, Small Cap Discovery Fund, Whole Life Income Fund 2, Lexi Growth Fund 2, Rising India Fund, Discontinued Policy Fund. So all these fund options are categorized based on their risk profile, which can range from low to high, and also their asset allocation is also, some has a higher allocation to equity or debt or money market, some has a combined asset allocation to all these. So depending on your risk profile and what kind of allocation you want to give to your investment portfolio, you can choose any of the investment options ranging from here. So now let's take a look at the investment strategies. There are 2 investment strategies. One is the enhanced smart investment option. Another is the life stage based portfolio investment strategy. So under enhanced smart option, this you need to understand this option is applicable till your premium payment term only, and the enhanced smart strategy is not available to use for your top up premium funds. So as a policy holder, you get the choice between 2 funds, a debt oriented fund and an equity oriented fund under this option. So, and if you want to know what kind of fund options are available under the debt oriented fund and equity oriented fund, you can refer to the policy brochure. So under these options, you can choose to invest in it. Another option is is the lifestyle based portfolio strategy. So under this strategy, your portfolio, like basically your investment portfolio, will be structured as per your age and risk profile, which is selected by you. Your risk profile can be conservative, moderate, or aggressive. So according to these factors, they will automatically shift your investment from riskier assets to safer assets progressively as you age. So they will invest your single premium or your annualized premium between the two funds, an equity fund, a debt fund, which is selected by you from their range of funds in a predetermined proportion, which you can also refer to the policy brochure to see how they determine and what kind of funds proportion they have determined and what kind of fund options they have available under this option to for more details. So these are the investment strategies available. Now let's take a look at the charges. So as a ULIP policy, it does have charges. So one is that, but you need to understand there are not other charges compared to other policy. Like there is no premium allocation charges like on your base premium or your top up premium, but they do have a policy administration charge, which charges based on if you have chosen a single premium method or a limited pay or regular premium method. Another is a fund management charge, which they charge based on the fund options you have chosen for them to manage. So this can range, the charges can range from 0.50% to 1.35%, just based on your fund options. Another is the mortality charge, which they charge for the life cover they provide you with. So this also depends on factors like your age. So based on the age you are in the policy, they will charge different charges. Another is the discontinuance charge, which depends on the year you choose to discontinue and what is your premium amount and what is your premium payment term. So another thing to remember is discontinuance charge is not there after the 5th policy year onwards. And as I have already said, there are not other charges like in other policies like partial withdrawal charge, fund switching charge, miscellaneous charge, premium redirection charge. These charges are all not existing in this policy. So as you can see, this policy does have relatively lower charges compared to other ULIP plans. However, the inclusion of discontinuance charge, policy administration charge, and the premium allocation charge itself makes it less appealing when compared to other market related investments. Now let's move on to understanding the advantages and disadvantages present in the policy. So let's start with the advantages. First, you have the flexibility to pay additional premium as a top up premium, and the sum assured will increase accordingly. And the systematic withdrawal facility allows the policyholder to withdraw the funds at predetermined intervals. You can choose either a systematic withdrawal plan SWP or chosen rate withdrawal plan or an index based withdrawal plan for withdrawing your funds from this policy. And during the policy term, you may switch your investment or part of your investment from one fund to another. So premium redirection facility helps you to allocate future premiums to a different fund or another set of funds, and you have the option to receive the maturity benefit either in lump sum or in the form of periodical payments over a settlement period of 5 years. So these are all the advantages you can get from this policy. Now let's move on to understanding the disadvantages. So a loan facility is not available under this policy, and the lock-in period is for 5 years, and during the settlement term the policyholder bears the investment risk in the investment portfolio. You need to consider all these potential risks as well while choosing to invest in this policy. Now, as we have a basic understanding of the Tata AIA Smart SIP plan, let's move on to understanding what is the internal rate of return, that is the IRR of this policy, to gauge what kind of returns we get in our hand if you choose to invest in this policy, for a better understanding of whether investing in this policy will be worth it or not in the long run. So just for calculation purpose, let us assume that a 35-year-old male has purchased this policy with a sum assured of 10 lakhs. So the policy term here is 10 years with a premium payment period of 5 years and annual premium of 1 lakh rupees. He has opted for the well secure option. So at the end of the policy term, he might receive the fund value. So what we have done is to calculate the IRR, we have assumed two rates of return. One is at 4% per annum, another is at 8% per annum. Which indicates both worst case scenario and best case scenario respectively. These rates are not guaranteed and do not represent the maximum or minimum number of potential return. It is just for calculation purpose to make the viewers understand that it is a market condition based product, right? So the returns IRR can also differ based on how the market is performing. That's why we have assumed two rates of return for the worst and best case scenario. So as you can see from the calculation, with a 4% return, the fund value stands at 5.49 lakhs, resulting in an IRR of 1.18%, which offers no value addition. So basically, if you have kept your money all these years in even a savings bank account, it would have given you a rate of interest better than this IRR of 1.18%. So basically 1.18% offers you no significant value addition. And another, this is for a worst case scenario, right? Now let's move on to understanding the 8% return, which is for the best case scenario. So the fund value increases to 7.54 lakhs with an IRR of 5.24% as per the Tata AIA Smart SIP plan maturity calculator. So while this policy is a market linked product, the return it generates are comparable to those of a debt instrument like bank FD. Even then, you can get guaranteed returns which is higher than this. So for long-term investment, return should ideally outpace inflation rate, right? Which this plan fails to achieve in the long run. So based on the return analysis, we can conclude that this plan is a low-yielding product and may not be suitable for inclusion in your investment portfolio. So what we are going to do is, we are going to explore the potential returns in other market linked products and using other alternative investment strategies, just to compare it with Tata AIA Smart SIP plan to see if there are better options available in the market or not. So here, using an alternative investment strategy where instead of combining insurance and investment, we invest in it both separately. So we invest the same 1 lakh premium, but we allocated it as how I am going to explain it now. So what we are going to do is, we are going to consider a pure term life insurance policy for life cover purpose with a sum assured of 10 lakh rupees. So the premium here only costs 5,200 rupees, leaving 94,800 rupees for investment purpose. So as you can see, the other metrics like policy term, premium payment period is all kind of similar to Tata AIA Smart SIP plan for a more fair comparison. So this investment can be directed based on your risk appetite. You can choose any kind of investment vehicle based on your risk appetite basically. But in this scenario, we have chosen to invest the surplus in an ELSS mutual fund. One, because it has tax benefits under Section 80C, and another is because it has, if you take a look at the track record, it has given a consistent return of 12% per annum if you choose to invest in it for a long term period like 7 to 10 years. So that's why we have chosen the ELSS mutual fund. This is also a market based product, so there is also risk involved, but according to its track record, it can potentially give us better returns if we choose to invest in it for a long time. So just for a fair comparison with the Tata AIA Smart SIP plan, which also has risk, we have chosen a risk-based fund. So at the end of the policy term, after redeeming the units, you can see, and accounting for the capital gains tax, the post-tax value of the ELSS fund is 11.15 lakhs from a pre-tax value of 11.88 lakhs. So even after paying off the tax, we have a fund value of 11.15 lakhs, and it gives you a return of 10.41%, which essentially beats the inflation rate. So this significant corpus can help you achieve your life's financial goals, because with a higher rate of return like this can support long-term wealth accumulation. So when compared this strategy to the low return of the Tata AIA Smart SIP plan, you can see why Tata AIA Smart SIP plan is a less attractive investment option, because here also we have employed kind of similar metrics and we have invested kind of similar amount, but still we are getting better returns while choosing to invest in insurance and investment vehicles separately. So now, what is the final verdict on the Tata AIA Smart SIP plan? Is it worth investing or not? As you can see, this plan offers life insurance coverage and financial security for your family, but upon closer analysis, it falls short in both areas. So the sum assured is too low to adequately cover a family's basic needs, and the investment component also lacks the ability to generate alpha, which is crucial for market-linked investments. So the plan's high charges and lack of transparency in its investment strategy contributes to its poor returns, and also it has a high agent commission. So in contrast, other market-related products offer greater transparency and lower cost, making them more attractive option. So while this policy does provide avoid systematic saving, the return comparison suggests that an alternative investment strategy is more effective. So what you can do instead is you can opt for a pure term life insurance policy with adequate coverage which ensures your family's financial protection in case of your absence, and the lower premiums also allows for more room to invest. So you can build a diversified investment portfolio which can better help achieve your financial goals. But if you want some professional goal based financial planning, then it's wise to consult with a certified financial planner, because they will be able to create customized financial plans for you tailored to your personal financial goals, time horizon, and your risk tolerance. So you can definitely invest through professional guidance as well.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.